You're building your business, but what happens when you stop working? Let's talk about the retirement plan no one's talking about. Your creative genius deserves the same precision behind the numbers.
Welcome to Let's Get Fiscal, hosted by Anastasia, Myiesha, and Danielle.
Part of the women-led team at Coterie Tax.
From smart tax moves to cash flow strategy, we decode everything it takes to run a thriving creative business
so you can scale with confidence and sleep easy at night.
Press play and let's grow your business.
Welcome back to Let's Get Fiscal. In this episode, we're going to talk about every young person's favorite topic, retirement. I like to really put this as a major piece just because it's something that can easily be a little bit missed when you are working for yourself.
Fair.
So I see a lot of small businesses, when you're working a regular job, you can have the money taken out automatically with your W-2. You're part of a 401k plan. You really don't have to think about anything.
Mm-hmm.
But when you're working for yourself, a lot of times you are saving money, especially in the beginning. There's not a lot of opportunity to save for your future because you are so focused on, surviving today, But at the same time, we want to make sure we get ahead of that. And then also there's a lot of tax strategies where people will say, oh, just spend all your money on equipment. And then that way you never have a profit. But also that means you're never paying into Social Security and Medicare.
Mm-hmm.
So when you're older, you literally have nothing, And I have people that are reaching retirement and they're going to have $2,000 a month. That's a big deal, if you are able to own your own home, own your own car, and then you have this extra stream of cash. So however you feel about Social Security and all of that fun stuff, that's why I like to present a few other options. Social Security, especially in the climate today, it probably is not going to be exactly the same when we retire. So how, you could say, great, I'll pay into Social Security and Medicare, but then also by the time I retire, maybe that's cut in half. So what did I even do that
I feel like that's
for?
a common thought of I'm going to be giving this money away, but who knows if I'll ever see any of it ever. Yeah.
Right. Mm-hmm. Exactly. So I tell people, okay, if we want to decrease some of your tax liability, what goes away is these items, and we could inflate them so that you have a great Social Security. But another option is putting it into things that you yourself have control over. Mm-hmm. And there's a couple different vehicles that are really great for that and at any income level.
That's
so
awesome.
That's what's really helpful because I always say, yes, we want to make sure that you survive today and get through, pay your bills, do all of that stuff. But it's very easy to just get into that survival mode and never actually take a step back and start thinking about the future. Mm-hmm. And so a great tax strategy and business plan will cover you for that future.
Mm-hmm.
So I guess, what do you even do if you don't have any money laying around?
When people think of their retirement plan, are they automatically thinking of their Social Security? Do they go hand in hand?
Most people aren't really thinking about retirement.
Okay.
And that creates issues because if let's say you are an incredible saver, you are hyper focused on retirement, you want to do all of these things, you will end up paying more taxes in retirement than you did when you were working.
Okay.
So it has to be a really balanced plan because you have those two extremes. You have the, I didn't save anything at all, and I have to do this forever. Mm-hmm. And then you have the, I did everything right, but I'm still kind of getting the short end of the stick here.
Yeah.
So that's where I kind of come into play and really help walk through what are the different options at each life cycle of the business and a person's just overall life and what they're looking for. So what I always like to say, the lowest barrier to entry is going to be the Roth IRA. Mm-hmm. So a Roth IRA, it doesn't have any tax savings today because you're paying on the taxes right now.
Okay.
And then when you pull the money out, when you're in retirement, obviously, or hopefully, you've remembered to invest the funds.
Yes.
Not all of the programs are super clear about that. Mm-hmm. But hopefully you've remembered to invest the funds and you've earned money off of those initial contributions. So when you take the money out, which is the original money you put in, plus any dividends and interest that it's earned, you don't have to pay taxes on it. And then also, it removes the requirement for a required minimum distribution. Mm-hmm. So that's going to be really key, especially when we talk about all of these tax advantaged retirement plans. Being able to lower your required minimum distribution is going to be really key in structuring what your income looks like into retirement. But the number one reason why I love a Roth IRA for somebody who is only focused on surviving is the money that you put in, you can take out.
Okay.
So let's say I do a job, I have an extra $1,000. I'm not really sure what I'm going to do with it. I can put it into my Roth IRA, but if I get a flat tire, I can take that money back.
Okay.
And it doesn't cost me anything because I've already paid taxes on that money. And there's no penalty for removing anything before retirement as long as I'm only taking the money that I put in. So you still can't touch any of the dividends or interest or growth. But if I put $1,000 in, I can take $1,000 out.
Okay.
That's really cool. I didn't actually know that. Yeah.
Mm-hmm.
Where do I find a Roth IRA?
I mean, really, they're everywhere.
Okay. Is there a RothIRA.com?
Because
no, it's held by financial institutions and investment firms. So
through my bank?
Vanguard, Schwab,
Fidelity.
Mm-hmm. But I've even seen where you can use different Bitcoin platforms to create retirement accounts. I mean, those will fluctuate a little bit more, but
awesome.
And there's even things where they call them like a self-directed IRA. So you can like invest in a spaceship or something, whatever. So there's, again, a lot of options like there always is in tax, but the easiest one is just going online to whatever investment platform that you're using or maybe a friend is using, and you can fill out the application online. And some of them, they take like 10 seconds to open. You know, like there's things like Stash and Acorns, really ones that are really super accessible because they want to make money off of you. So they'll make it easy for you. But like I said, especially if you're not really sure, but you know you want to save, having it in that Roth IRA is really, really great. It builds your nest egg and it provides for your future. But if something happens, you can still take the money out. So a lot of people, when they're thinking about their retirement, they're really worried because I don't want to take $5,000 and then it's stuck there for 50 years. So then what do I do with it? You know, so that's where that Roth IRA comes into play.
Interesting. What about my 401k?
So 401ks get a little bit more complicated. There's different levels, especially if you are running your own business. So like I said, that entry level is going to be that Roth. And when we start making a little bit more money, then we start going into a SEP IRA, maybe a traditional IRA, depending on how much cash is available. And then once you've kind of hit the ceiling with the SEP, then we start talking about a 401k. A 401k generally has higher costs to run the plan because it is a very structured plan. A lot of times you have to have a TPA, a third-party administrator, to make sure that you are meeting any of the safe harbor requirements. So it can get pretty complex pretty fast, which means that it costs money to do that. So normally you have to pay attention to the 401k and decide whether or not you're going to put enough money into the 401k to cover all of the costs, and then, not the cost of the TPA, the cost of the plan, and then the cost of that annual paying an accountant to do that annual review. And then we also have to look at some of the things that happen when you have multiple employees under the plan. So lots of different things. But I guess to kind of backtrack a little bit, that's, kind of the overall step up of that. So you start off with that Roth, but Roths are designed for lower income individuals because they want to incentivize you to put more money into it. And then the same thing with a traditional IRA. You can use a traditional IRA, super easy to set up, but that you get to deduct it on your tax return. So that means you can't remove the funds until you reach retirement, or a certain number of different life events that have been approved happen. But either way, you have to pull back that income tax because you didn't pay it when you put it in. So once you start making in the 6-figure range, we still want to include that Roth. Because like I said, if you're really good at saving, you have this extra cash, which you would if you're meeting those income levels, hopefully, depending on
lifestyle choices.
Right.
Yeah.
So what we do is called a backdoor. So when you're in a Roth, if you're single, you make above $150,000, or if you're married and you make above $236,000, and those numbers change every year just for funsies, then you cannot make a direct contribution into a Roth IRA. So we do something called a backdoor Roth.
Okay, sounds like a loophole.
I mean, it's I don't necessarily say loophole for things that are just written into the tax code and available for anyone to use. They're just like green flags saying like, please use me. But with the backdoor Roth, so basically you contribute your funds to a traditional IRA. And because the traditional and the Roth are both tailored to lower income earners, when you put money into the traditional IRA, you don't get the tax benefit after a certain point in time. So you're paying tax in, and then you're also going to pay tax out. So then why put money into that traditional IRA?
Okay.
But what we can do is we can put the money into the traditional IRA and then request that they convert it into a Roth. And so there's no income limitations to converting from one type of retirement account, a taxable retirement account, into a Roth. So when you do that, you're claiming back the income, but you are already going to pay income tax on it. So it creates a neutral tax situation, but it allows you to fund that Roth IRA and again, be on the right side of those required minimum distributions. And a lot of people, like I said, they don't know about required minimum distributions until it's too late.
Okay. All right, we'll explain that a little bit more then.
Okay, so when you put money into a traditional IRA or 401k, you don't pay any tax on it when it's going in, right? Okay. One of the things with those accounts, though, is it's like, okay, great, we're not going to charge you tax until you take money out of it. So somebody might say, well, then I'm just never going to take the money out of it, right? And so the way that it's structured is you can't do that. So there is a certain age that you can reach, that once you reach it, you are required to start taking distributions from your 401k, your SEP IRA, your traditional IRA, with the goal of the account being empty at the end of your life expectancy.
Oh, okay.
So, do they work with insurance companies? Like, I mean, like, how do they know what your life expectancy is supposed to be?
It's all standardized.
Oh, right, okay.
Right, yeah. But I mean, you know, people are living longer and longer now, or shorter.
Or shorter and shorter.
Depending on, your lifestyle. But that's where, you know, if you have $100 million in your 401k,
right,
that might be detrimental to you in retirement because that account has to be empty by the time you've reached your life expectancy.
Okay.
So with a Roth IRA, you've already paid the tax, so you don't have to worry about that. So you can really structure how you take your income. So if you have a child that's getting married, or you want to take a big vacation, you can take larger distributions, or you can decide, I'm just going to stay at home and read a book. I don't want to do anything this year. And you don't have to take money out of it. So, but with a 401k or a traditional IRA, they're going to make you take that money out of the account. And if you don't take the money out of the account, basically they're going to charge you so much in tax that it starts to get a little bit ridiculous. And then you're just basically giving away money that it's going to cost you more to leave the money in there than it is to take the money out.
Right. Gotcha. Okay.
So that's why we're a little bit careful.
Yeah, that makes sense. So they don't care as much about Roth because they've already gotten their money.
Right.
So it's like, okay, you can hang out with this in here. That's fine. Yeah. Okay. That makes sense. But they want to make sure that they get their money at the end of this. So you got to do something. Yeah.
Exactly. Once you have that 401k, they're going to make you start taking that money. So you start out with that Roth. Then once you are comfortable maxing out that Roth, we have conversations about either a traditional IRA or a SEP IRA. And it can kind of go first traditional IRA because those you can put in a maximum of $7,000. And then we can start talking about the SEP IRA, which is 25% of whatever your profit is at the end of the year when you're a single member LLC. So 25%, if you only made $5,000, that's not going to be very much. So that's when we fund the traditional IRA, and then we can, put the $5,000. We completely wipe out that income tax on the $5,000, and then we've also saved you some. So it really depends. I mean, a lot of times what I tell people is you have a couple of choices when it comes to taxes. You can keep the money and you pay the full tax amount on it. You can spend the money and give it to, one of these bigger companies buying equipment, whatever, and you lose 100% of your money. Or you can put that money into your retirement account and you get to keep the money, but you still get the same benefit as if you just went out and bought a brand new computer or something like that. So when people are, I'm going to just buy a new computer every single year, well, there's your retirement money right there,
Interesting. Okay.
And it counts basically the same as if you were to go out and buy this additional equipment that maybe you don't necessarily need at that point in time.
Okay.
So when we talk about retirement, a lot of it is let's spend money to save on taxes, but do it in a way so that you still get to keep it.
Yeah.
And that a lot for me is really big with tax strategies is if you're spending money, it should be increasing your quality of life or moving you to your goals, not just random spending, like I said, because then you lose 100%.
Right.
So from there, we start funding the SEP IRA. And a lot of these things are going to happen when you're a single member LLC, just still in those infancy stages with the company. You can fund it with 25% of whatever your profit is. You still have to pay some extra Social Security and Medicare tax on it. So once we get into the S corporation structure, that's when we either do the SEP IRA or the 401k. And so it really depends on how much money you want to start investing. So again, the 401k can be a little bit more complex. So a SEP IRA, it's basically like another IRA. You just go online, fill it out with whoever, and you can be done in 5 minutes. And then you process your payroll that you're required to do on your S corporation. Yeah. Then you divide that by 4, and that's how much money you can put into your SEP account. And that's really, that one, you're able to take that deduction without it being affected by Social Security and Medicare. So that also plays into effect, because with the S corporation structure, you've already paid all of your Social Security and Medicare there. So you're able to take the deduction, decrease your tax liability, and also, I mean, in some cases, you can put away $20,000, and that $20,000, it's still accessible to you in some ways. Yes, maybe you won't be able to pull it out until retirement, but there's still options of taking a loan against it, or maybe you can take $10,000 for your first home. If you have any medical issues, you can use it then. So there are certain situations where it would still be available to you, and you get that $20,000 deduction, but you didn't like lose all of that money spending $20,000 on things that you didn't necessarily need.
What if you wanted to combine them?
So you can combine a few of them.
Okay.
So the Roth and the traditional IRA, those are around no matter what you want to do. Whether or not you get a benefit and how you work around, that changes depending on what your income level is. But when you get to the SEP and the 401k, you have to choose one.
Okay.
So at that point in time, the SEP and the 401k are going to be employer sponsored. Okay. And so the employer can only have one type. Okay. Now, you can have multiple employers that each provide you one of these types. And there is that maximum that you can put, and you have to kind of watch how much you're putting into each one of them. So it is kind of possible to have multiple, of SEP IRA with one and a 401k with another, which sometimes happens when you're freelance because you have your own S corporation that's providing you with the SEP IRA, but maybe you have a part-time W-2 and you want to
401k.
With a 401k match. So people are like, well, can I actually do that? Should I leave that 3% that they're offering me on the table? I say, no, just take it. Take all the money you can get.
That's what I was wondering. But wouldn't it make sense to put them all together so that the interest grows faster?
Not necessarily, because they're all going to have the same interest rate. Right. $100 here and $100 there at a 2.5% growth. It's, I mean, you're going to have, it's all going to compound and everything.
Okay. So it's okay to keep one here and one there.
Yeah. And I mean, even to that point, some people, you can have 7 different accounts.
Okay.
Maybe you have one from an old employer, one from a new employer, one from
that's what I was wondering, because I have a few different ones all scattered around, and I was wondering, do I put them all together or do I keep them where they are? So
sometimes that's kind of more of a personal answer. Yeah. Sometimes it can be kind of a pain to roll them all over into one.
It's becoming a pain.
I tried it. Yeah. When I took a break to be a stay-at-home mom for a bit, I was like, well, they're not allowing me to contribute to these accounts anymore. And some of them I had only worked at that place for a few months. So it's just do I just take it and then take whatever, if there's a penalty? But I was always told when you're young that you're supposed to do the Roth. So when I was first starting out into corporate world, they're like, do the Roth, get your taxes out now, you're young. I didn't know it was because they were just not paying me a lot of money. So they're like, you need to do the Roth since you're not making any money.
I didn't even hear of Roth till
so I was like,
today.
Roth. Yeah,
probably.
Sounds great.
Yeah, I heard of Roth not even this year.
Yeah. Okay.
So, I always had 401ks for every job I ever had. And I have I have 3 401ks in different areas.
Yeah.
So
you can, because they're all pre-tax, they call it rollover. So you can roll them all into one account. That way you're not having to track down 50 million accounts.
Okay.
So you can combine them, but at the end of the day,
doesn't really matter.
The employer, right. And the employer can only provide you with one of these plans, either the SEP or the 401k. Okay. And it's by employer. So you can have multiple employers that each provide you one of these retirement plans. there is still an overall maximum that you can put in there. It's, about $70,000. So you do have to watch out for that to make sure that you're not, contributing too much and duplicating things.
I'm not.
So the SEP IRA, it's normally, like I said, like a really low barrier to entry. And if you're only planning on contributing under the 20,000 mark, I normally say that's going to be the easiest one to go for. You don't have to contribute to it until April 15th of the following year.
Oh, that gives you more time too. Yeah.
Right.
Yeah.
You get a little bit more time. You hopefully have a good idea about what your taxes are. So if you have the extra cash to put in there. And then you can also see what the differences are and how much money you're saving if you put money into the SEP versus keeping the money. And depending on, like I said, depending on the growth cycle of the company, sometimes it makes sense to pay 20% in income taxes so that you can use the rest of the 80% to grow your business. So it's kind of layering in some of those questions. But once you start getting into the point where you can put more than $20,000 into an account, we start talking about the 401k.
Oh, okay.
And so a 401k, again, a lot of that has to happen during the calendar year.
Okay.
And so we're pushing forward all of those due dates again. But with a 401k, what we're able to do is whatever your payroll is, you can put in $23,500. So if your reasonable compensation, again, is going to be $50,000, your SEP is going to max out at $12,000. But the 401k will continue going. And what's great about that is you don't have to increase your payroll, which increases your Social Security and Medicare, because that's going to cost you about 16% to increase your payroll. But then if you're getting yourself down to an 11% tax rate or something, there's not a lot of benefit to increasing your payroll just so that you can put more money into the SEP. And so that's where we do the 401k, because the 401k, as long as you're paid as much as $23,500, you can put all of that into the 401k.
Okay.
Then what we do is you can layer in a profit share. So you take your payroll and you can have the business elect to put 25% of your payroll into your 401k as an elective profit share. So now you've just done exactly what you did when you were using the SEP IRA, but you've increased it by $24,000 roughly.
Okay.
So at that point in time, it makes a little bit more sense to take on the extra responsibilities that can happen when you have that 401k.
Interesting. Is that like having stock in your own company?
No, because you use the 401k to purchase stock or, bonds and money markets of other companies. So you're like investing in the stock market, or a lot of them, you can just say like, I want to retire in 50 years. Figure that out for me.
Yeah. That was my next question also. Yeah. I need that calculation to tell me how much I need to save in order to retire at 45.
Yeah, a lot of that's going to be 45. Okay, I don't know your age, but like I feel like it's not like that crazy.
It's not that
from
far.
45.
Yeah. So a lot of those are questions more for a financial advisor. All I could say is just make sure that you're investing it and it's not sitting in an account somewhere. And that's another thing. You want to make sure that your money is working for you. You just busted your butt earning this money. And so now it's time for it to work for you, because every day that it just sits in a checking account, it's losing value. So we want to just be really careful and mindful of what we're doing with money, and that every dollar really has a purpose and is doing something for you.
What if the market crashes?
Well, a lot of that you're going to be investing in the market long term. So the market will always have highs and lows, but the overall idea is that the trajectory long term is going to be positive. So
what
even
if in
you,
the Roth IRA, let's say I put $1,000 in it and the market crashes, do I still have $1,000 in it?
No.
Okay. Just checking.
No.
Okay.
You could empty it and then you wouldn't, you wouldn't pay any taxes because technically you're only taking the money that you put in.
No, I mean, I want to keep it in there, but if the market goes down, my money could also go down. Okay.
Exactly. But it's all a waiting game.
Okay.
So when you're investing the funds, you want it to sit there for 10, 20 years.
Okay.
So there are some investments that go completely awry. But overall, that's with a financial advisor. They can help you with some of those investment pieces. And then also, like I said, a lot of the accounts, they structure funds in a certain way so that they're creating the return that you need in order to get to your goal number. And they'll exchange stocks. So if one of them is underperforming and it's not getting you to your goal, then they'll be changing the fund in that way for you. So you don't necessarily have to think about it.
Yeah, I have an account like that.
So a lot of times it's just put the money in there, get it investing. Once you have a decent nest egg, then you can start bringing in a financial advisor and doing all of that. But for the most part, you can kind of self-direct a lot of it.
They even have it like when I've signed up for them in the past. So they like kind of give you an option of like, do you want to have like high risk? You want to do the safer route? Like they like kind of give you those levels as well.
I just signed up for one of those and I'm not sure if I did the right thing. So I'm going to have to look at it again.
Well, I mean, it is good to look at it. And even looking at things, it's something that you should be doing constantly anyways. You should always be a little bit mindful, again, of your money, making sure it's doing what it needs to. But also people don't recognize that you also need to check your Social Security account every single year. So
there's a way to do
that?
Yes.
Is that a thing?
I had no idea.
Okay. So Social Security is when you are eligible for Social Security, they take an average of your highest 30 years of working. So that's why I say you got to hold up if you're going to have 10 years of where you're zero.
Okay.
Yeah. So
your average 30 years of working pay.
Well, 30 years, the highest 30 years. So if you worked 40 years, then the lowest 10 they're going to get rid of.
Okay.
But if you didn't work anything, or you have years within that 30-year time period that have zeros,
now I'm getting nervous.
It's going to be it's going to drop you. So again, let's say you only work 25 years. If 5 of those years you don't earn anything because you are so worried about your taxes that you dropped everything to zero, so you didn't have to pay any taxes. Now you have 5 years of zero up against your Social Security.
Okay.
So then you got to be a little bit careful. And what ends up happening sometimes too is sometimes systems forget to report your earnings to Social Security.
Okay.
So
maybe if we take it back a step of like, where do you go?
Can someone get me a calculator?
Yeah. Like, what is it? A website?
Yeah.
It's just like I feel like that's like
website.
That can't be safe. Like identity theft or whatever. Like it's a website.
It's really interesting. They know back, and like to
people
the
need to know.
80s.
Oh, okay.
Right.
Okay.
Right. They know every single year how much you claimed, from your W-2 or from your taxes that was subject to Social Security and Medicare. It'll list it all. So the problem becomes sometimes there's certain payroll systems, things can happen. It doesn't always have to be like nefarious embezzling that affects it. It could just be, just a random system error that prevents one of your employers or from reporting your income to Social Security. and you only have 3 years to correct that. So let's say last year I had I had a W-2 for $100,000. If something happened and Social Security doesn't have record of me earning $100,000 on a W-2, if I don't tell them that and fix it within 3 years, it's going to stay as 0, even though I paid Social Security and Medicare on $100,000.
Interesting.
Okay.
I guess it's like, that seems like a flaw with the system then, because you're filing a tax and like it says it all on
Some systems
there.
are flawed.
So like, do you know what I mean? Like, why are you worried about the payroll system? Like, I feel like you should be just looking at the thing that like tells you what I did.
Yep. But I mean, at the end of the day, and it's the same with taxes, it's all 100% your responsibility. So it's up to you to be educated and to pay attention and to know all of these things just randomly from the sky. But it is your responsibility to be checking on that because, like you said, yes, the employer should be doing that. But at the end of the day, it's your responsibility to make sure that they are actually doing that. Gotcha. So every year you should be just double checking all of your retirement accounts. And if you are putting anything in Social Security, making sure that Social Security actually receives that information because they don't necessarily always receive it.
Right.
And because it's an average of your last 30 years, if you have years that are zeros, it can affect some of that information.
Wow.
Learning something
I can't
new.
wait to check.
Yes. As soon as we're done with this episode,
How old am I?
Where do I check this?
30 years.
I know. I mean, sometimes it's fun because you can see the trajectory.
No,
and
it's going to be fun for me. I've already worked a very long time, so. Yeah.
I mean, if you think about it, if you started at I started at 16. Yeah.
Right.
Yeah.
I might stop working now. So. All right.
Yep. So that's why I say, you don't want to necessarily completely nosedive all of your Social Security. And if you are saving money through an S corporation or another structure on that Social Security, you need to be careful that you're also putting it into retirement funds that you control. Because I'm totally fine with like, okay, maybe you don't want to put as much money into this system, but you still will need something. So let's take that, I kind of say, if you save $10,000 in taxes, that money is already gone. The IRS had it earmarked. So if you were able to kind of claw that back, let's put it somewhere, we can put it in the retirement account. And then that way it's not necessarily 100% gone, but it's also not money that you necessarily would have seen otherwise.
Save you from yourself kind of thing. Spending it.
So instead of being like, oh my gosh, I saved, like $100. It's like, okay, let's take that money, keep your lifestyle the exact same way, and let's put it into retirement. Or again, make sure, it's being invested into your business and growth, or maybe into a rental property, whatever you want your structure to be. But it shouldn't be, okay, I saved a whole bunch of taxes, let me go out and buy a new car, or, because then you have all of that lifestyle creep come into play. Okay. So we're also kind of combating some of that. But I love the 401k, like I said, because it allows you to increase the amount of money that you want to put away for retirement. And it gives you that extra tax deduction without having to give it away to somebody, some faceless corporation.
I always liked 401k also.
Yeah. And then, it's still kind of available to you at a later point in time. Yeah. So it has a lot of really great benefits there. But I always say there's no reason to complicate your life if you don't need to. So that's why a lot of people just go towards the SEP because it's just nice and easy, 25%. I don't have to do anything. It can be done April of the following year. So you know how much money versus a 401k. you have to have a plan. You have to have payroll. It has to be listed on your W-2. So that means you have to talk to your accountant. If it's, there's a lot of different things that happen with the 401k that normally I say, if you're in a position where you can start putting $30,000, $40,000 into retirement, then that's the point where we start talking about that 401k. Yeah. And before that point, we can just layer in a Roth and a SEP and you'll be perfectly fine. And then also, one of the things that I really like to do is, obviously, there's different life cycles of a business. So especially in the creative field, you have that feast or famine. So in those feast times where maybe you have a lot of extra cash sitting around, you're most likely paying a higher tax rate. We're going to fund that 401k as much as possible. Okay. And then in those famine years where you're not making as much money, you have a lower tax rate. We're going to do Roth conversions. So then you just saved money in the difference between your original tax rate and your current tax rate. And you've also gotten rid of some of those required minimum distributions. So finally, once you're in the super saving part, that's where we can start layering in a pension. So your business.
Oh, great. So okay, now I need a pension. Okay, I forgot about pension.
So again, there's a couple different types of pensions. There's one where you just put money into it, and whatever is in the account when you retire is the amount that's in the account. Or you have one that basically promises, I'm going to provide you with a certain amount of money every single month when you retire. And then that we have like an actuary that determines, based on your age, how much money needs to be put in there. And a lot of times, a lot of people really love that for when you have an older business owner and a really young employees, because the really young employees, they're not going to need as much money in the account. But the older business owner is going to reach retirement age earlier. So you're going to fund it with a whole bunch of extra money. So the tax savings from you funding your own retirement more than cover what you're spending on some of these other employees. And you can layer in a 401k and a pension and put in hundreds of thousands of dollars into these accounts. So, and there's even, I think there's some things that you can do when, you say like, okay, well, an IRA, a pension that's supposed to be around until I retire, that's a 20-year commitment or more. So there are ways where you can close a pension plan a little bit earlier so that you don't have to commit to putting $100,000 into an account for forever.
Yeah.
So there are ways to get around that. But a lot of times those are more structured for businesses that are high earning, that are projected to continue to be high earning and a little bit more stable versus in those initial growth phases. So there's a lot of layering.
I'm hearing it. Yeah.
Right. Yeah. But again, if you're able to put in, $150,000 into your retirement accounts every single year, that's when we have to really start seriously considering that required minimum distribution that, again, nobody realizes until it's a little bit too late. So we have a whole bunch of different avenues. And then we also have some different ways that those funds can be kind of clawed back before the time frame. So again, saving nowadays $10,000 for your first house really isn't a lot. But you know what? If I can have $10,000 tax-free, I'll take it, whatever. Sometimes they can be used for college tuitions, which is great for growing families. And if you have any major medical issues there's even provisions where if you're a victim of domestic violence, you can pull from your 401k. And a lot of people don't know that because that's a situation where you're, you need cash and you're not necessarily Sure. Right. So there are special provisions to assist with that as well.
Yeah.
And then, like I said, with the fires of the pandemic, there were programs where you could withdraw funds and you can pay it back or pay the income taxes on it, things like that. So it's also working with a tax professional to, when these major things happen, you know, I tell people a lot of times I'm kind of like, I know more about them than anybody else. And I'm a little bit more of a therapist than anything. Just because, you know, like, this whole thing happened. What do I do? What is my next step? How do I get this cash? And how do I actually do this?
Right.
And so there's a lot of different opportunities that are available that some people just don't even know about.
Yeah,
so
definitely.
That's why even if you are in that starving stage of your business, these accounts can still really, really be beneficial as a way to continue saving. And then again, it's a way where you get to keep all of your money. You know, you're not giving it away to Social Security. You're not giving it away, buying all kinds of equipment or spending it on food or what have you. You were able to get the same benefits, but the cash is still there. And if something happens, you can grab what you need. So
making your money work for you.
Right. Exactly. So that's why I say a lot of times retirement is going to be a big piece of a tax strategy. And even in those higher ranges, doing things like the backdoor Roth. So that you can still get the benefits of that Roth account later on in combining that with your pre-tax accounts can be really good. So
there's a lot to consider. I like that there's stages though. So like when you get to this point, then maybe we do this, and you know, like it's okay to start with a nice, simple, easy stage, and then like as everything grows, you can like complicate it and like make it work for you in a really good way.
I think like this is a really great example of there's not one answer. There's not one right answer here.
Right.
And you can put the money into multiple accounts, but it's also, I like to be able to see, okay, what actually happens when when I do this versus if I do this versus if I do that.
Yeah.
And then that's where we take that tax strategy, because at the end of the day, taxes is just math. So I can, as long as there's not any major tax legislation, which there will be.
Do you have to pay taxes when you retire?
Yeah. Yep.
What are you paying taxes on?
Well, on your required minimum distributions, interest, dividends from investments, Social Security, depending on how much money you're earning. So there's a lot of different ways that you would,
That's a bummer.
Dead people pay taxes. Everyone pays taxes.
Great.
So I tease. I'm like, you might tell them until death do us part, but you're with me even later. Right. And that's why you have to really think about your plan. And so I'm able to predict out, okay, let's see what the next 5 years look like. And let's take a couple different scenarios and maybe pull a piece from each one of them.
Yeah.
Because maybe you're like, okay, well, I only have $5,000. So what do I even do with this money? And does it make sense? And does it, again, like further what I'm trying to do in my life in the way that I expect it to?
Right.
So
should I buy Bitcoin?
I can't tell you any of that. I'm not a financial advisor, so I can't really say how to invest it. But I can tell you what happens when you try to take it out. So I guess that's a lot of retirement. I get a lot of questions about that, especially the backdoor. So again, just put the money into an empty traditional IRA, completely brand new. Once it hits the account, we ask them to convert it into that Roth IRA. And then that way we still get all the benefits of the Roth, but we don't have to worry about any of our income limitations. And then we can do mega backdoor Roths, they call it, when we, I know,
Okay.
So many different words. But
awesome.
Do that mega backdoor Roth in those kind of more famine years so we can balance out your overall retirement strategy. So, and that's, I mean, like I said, why a good tax strategy includes who are you?
Yeah.
What are your values and what's important to you? Because some of these actions have to happen years before.
Yeah.
So even like a mega backdoor Roth, you need to do it 5 years before retirement. You know, there's different things that have to happen before you're even considering retirement. So when are you going to retire? Where are you going to retire? How much money do you need? Because in Georgia, they don't tax retirement as heavily as they do in California. In California, everything gets taxed and you're going to be taxed 100%. In Georgia, they give you an allotment where they'll say, hey, I'm not going to charge you any income tax on the first $50,000 that you take out of your retirement account. So even where you plan on retiring really makes a difference.
Okay.
So
interesting. I bet Florida's pretty
people
lenient.
love going there.
Yeah. No?
Well, Florida doesn't have any income tax at all.
That's probably why.
So, you move from New York City and then you go where you have the New York State and the New York City income taxes.
Right.
And then you go to Florida where they have no income taxes.
Okay.
But I mean, even that, you have to be super careful because residency is a big thing. But that's why I say, you know, really taking the time to sit down and say, what is it that I want? How am I going to get there? And even in those really super early stages, recognizing that you don't have that backstop of that employer that's going to automatically put that money in there without you seeing it, without you even thinking about it. You need to be your own advocate and you need to really think about where everything is going because like I said, if you have 5 years of your last 30 years that are all at zero, maybe you can't rely on Social Security at that point in time. So you need to be able to have other avenues where you don't have to do this forever. And I mean, we all start businesses and we work in businesses because it's our passion and it's our life. We want to do it forever, but it is definitely a different scenario when you have to do it forever.
Yeah, the want and the having too. Yeah, fair.
Yep.
So it seems like it's a lot of just like intention that is not always necessarily the case when you are working a normal W-2 where you don't have to have as much like thought into it. So makes sense.
Yep. So I think key takeaways are going to be, number one, put money into your Roth account, especially, you know, if you're not earning a lot of money, just throw it in that Roth account. It's not locked there forever, so you can take it out. And then number two, if all you're doing is trying to chase expenses, retirement should be the biggest expense that you chase. Don't try to get a new computer. Don't try to get a brand new desk every year. Fund your retirement and you'll get a lot of the same benefits, but you get to keep the money at the end of the day.
Right.
I like it.
Awesome.
Thank you for joining us and learning a little bit more about retirement. If you have any questions, feel free to leave a comment below or reach out to us. And don't forget to like and subscribe on whatever platform you use for podcasts so that you can keep up to date with all of the interesting business and tax information we have to provide. That's a wrap on Let's Get Fiscal.
Ready to stop guessing and start saving?
Click the link in the show notes.
Grab your consult and let's make your business work for you,
not the other way around. You've got this.